New Zealand house prices have crashed 17% from their peak, and they're still falling. Now, before you panic or celebrate, depending on which side of the property fence you're on, there's something far more important happening beneath the surface that almost nobody is talking about. Over the last 45 months, that's nearly 4 years, we've watched one of the most dramatic housing corrections in New Zealand's modern history unfold. Auckland's down 22.5%. Wellington's been hammered even worse at 25%. Even traditionally stable Dunedin is down over 11%. But here's what makes this story absolutely fascinating. The Reserve Bank has slashed interest rates by 2.5% with more cuts coming. According to every economics textbook ever written, cheaper mortgages should mean higher house prices. But it's not working. Prices keep falling anyway. So what's really going on here? Is this the crash everyone's been predicting? Should first home buyers be rushing in right now? Or should they wait on the sidelines? And perhaps most importantly, if you're watching this from Australia, should you be worried that what's happening in New Zealand could happen across the Tasman? The Reserve Bank's own forecasts have swung wildly. At the end of last year, they predicted 7% price growth for 2025. By May, that dropped to 3.5%. Now, they're forecasting a 0.3% decline. That's a massive revision in just months, and it tells us something crucial. Even the experts are struggling to understand this market. But buried in all this uncertainty is a story that could reshape New Zealand's property landscape for a generation. Housing affordability has improved to levels we haven't seen in a decade. The median house price to income ratio at a 10-year low, mortgage serviceability, the best it's been since the mid-2010s. For young Kiwis who've spent years watching property prices rocket away from them, this correction, painful as it is for existing owners, is opening doors that have been firmly shut for nearly a decade. Welcome to Kiwi Property Reports. I'm bringing you the latest comprehensive analysis of New Zealand's housing market as we navigate through late 2025 and head into 2026. And the picture we're seeing is far more nuanced than the headlines suggest. Today we're going to unpack 3 critical elements of this story. First, we'll examine the full scale of the price decline and why traditional economic tools aren't having their expected effect. Second, we'll look at what's actually happening on the ground, who's buying, who's selling, and what the spring market might bring. And finally, we'll explore the silver lining. The dramatic improvement in affordability and what it means for first home buyers and the broader market. Let's get into the numbers. Nationally, home prices have dropped over 17% in the last 45 months. But here's the context that matters. Prices are currently only 3.4% higher than they were 5 years ago. Think about that. If you bought a property in 2020, you've essentially seen minimal growth over half a decade, and that's before accounting for inflation. When we adjust for inflation, real housing prices in New Zealand have come back to pre-pandemic levels. The speculative frenzy has been completely unwound. According to data from Cotality and visualizations by Justin Fabo at Antipodean Macro, the regional story is even more striking. The nationwide median value now sits at $809,113, the lowest level since August 2023. This comes after prices fell 0.2% in August alone, marking the 5th consecutive month of decline. So far in 2025, prices are down 0.6%, completely wiping out last year's gains. Now here's where things get genuinely puzzling. The Reserve Bank of New Zealand has cut the official cash rate by 2.5%, with another 0.5% worth of cuts expected by the end of 2026. According to Justin Fabo's analysis at Antipodean Macro, this fall in the OCR has reduced the cost of new mortgages. Economics 101 tells us this should increase housing demand and push up property prices. But that's not happening. Despite these significant rate cuts, housing values continue to decline. The Real Estate Institute of New Zealand announced a 0.5% decrease in home values in July, the largest monthly decline since April 2024. Why aren't lower interest rates working? Several factors are at play. Consumer confidence matters. Employment prospects matter. But perhaps most importantly, the psychology around housing has fundamentally shifted. People's mindsets have changed. After years of relentless price growth, Kiwis are experiencing what it's like when property values actually go down. And that changes behavior.
House prices continue to stay low. Good news for buyers, not so good for sellers. The latest Real Estate Institute figures show the median house prices
You've probably seen headlines screaming about a housing market crash, but some commentators are pushing back on that terminology. Kelvin Davidson, property economist at Cotality, offers crucial perspective. He points out that a lot of those falls happened over 2022 and 2023. In the past 2 years, it's been much flatter, with prices moving up a bit and down a bit. Certainly in the last 4 to 5 months, Davidson notes, we've seen that prices have just slipped ever so slightly backwards after a period during the last year where they rose a bit. He uses Dunedin as an example. It was down 1 month, but up the next. Auckland prices were down 0.5% in August, whilst Dunedin was actually up 0.4%. Davidson's assessment: whilst it's not accurate to describe the current situation as a crash, we're certainly not emerging into an environment where prices are rising either. The market is tracking sideways. Wellington's sharp downturn has petered out, though prices are still falling slowly, down 0.1% in August. There's tentative evidence that more economic resilience in provincial areas is supporting property values. Nelson, Invercargill and New Plymouth all recorded values lifting by at least 0.5% in August. However, not everywhere is experiencing this bounce. Gisborne, Hastings and Napier were down 0.5% or more. So what's actually happening on the ground? Has the market frozen up? Interestingly, market activity remains reasonably robust. Westpac chief economist Kelly Eckhold notes that people are still borrowing money and investors are returning to the market. Davidson confirms there's still strong activity from first-home buyers, and a rising share of the market is going to investors. That includes the cliché mum and dad investors who are enjoying lower mortgage rates and reduced top-ups on their rental properties. But here's what's particularly interesting.
Down 1.7% here, a loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5%, 5%.
We're 16%, 18%.
43%.
Stock on the market is starting to fall, and it's broad-based, happening in basically every region. Listings are still at fairly high levels, but they're starting to fall. Davidson believes spring will be particularly interesting, because sales volumes have been rising for a while. If sales can continue to rise and outpace new listings coming on, then stock on the market will continue to decline. It'll still probably be a buyer's market for a while, but slightly more competitive price pressure might emerge in the last few months of this year and into early 2026. The lagged effect of falling interest rates and improved affordability, combined with a falling unemployment rate, could be expected to push prices up. Davidson is careful though. I'm not saying it's going to be a boom because I think the mindset's still pretty pessimistic, but some of those things that have been holding house prices back will probably turn around. So a bit more growth in 2026, but we've got to get through the rest of 2025 first. Now here's where this story takes a positive turn, at least if you're a young Kiwi trying to get onto the property ladder. The major upside is that New Zealand's housing market is becoming rapidly more affordable. And I mean rapidly. According to Justin Febo's analysis, New Zealand's median house price to income ratio has fallen to a decade low. We haven't seen housing this affordable relative to income since the mid-2010s. But it gets even better. Mortgage repayment affordability has also improved to its best level in a decade. This matters because it's not just about the sticker price, it's about whether you can actually afford the ongoing repayments. For young New Zealanders who spent years watching property prices rocket away from them, this represents a genuine opportunity. The combination of lower house prices and lower interest rates is creating the most accessible entry point into the housing market that we've seen in years. New Zealand has long been watched as a canary in the coal mine for the world's property markets. So what does our experience mean for other countries? We're not alone in experiencing a major reversal. Canadian prices have slumped by 150,000 Canadian dollars since 2022, leaving the median Canadian home nearly 20% cheaper. Australia, meanwhile, is yet to experience a crash and will be looking at what's happening here closely, Dr. Rem said. Like New Zealand, Australia doesn't have many institutional investors in the market. It's a lot of mum and dad investors, Rem explains. They're all banking on the fact that housing is going to increase in price, and if it doesn't, then that's a huge problem. Brad Olson suggests Australia might be looking at New Zealand's slowing market with envy as they watch their own prices continue to rise. If I was looking at other countries like Australia, I don't know if I could say, you know what? Things look like they're getting into a better place. They're just continuing to get more and more unaffordable. The lesson: markets that experience extreme booms, fueled by low interest rates, limited supply, and investor frenzy, are vulnerable to sharp corrections when conditions change. The question for other overheated markets isn't if a correction will come, but when and how severe it will be. Before we wrap up, there's a crucial lesson here that extends beyond New Zealand's borders. Australia is watching what's happening across the Tasman very carefully. According to recent analysis, Australia's dwelling value to income ratio was tracking at a record high of 8.2 in the September quarter of 2025. The percentage of median household income required to service a new mortgage on the median-priced home in Australia was historically high at 45%. Despite 3 25 basis point rate cuts from the RBA. Most economists and financial markets are tipping 2 25 basis point rate hikes in Australia in 2026. Such an increase would take the official cash rate above 4% and average mortgage rates to near 6%, the highest in the world. The clear risk is that Australian housing could follow New Zealand and Canada, arguably Australia's most similar economies and housing markets, with a deep housing correction. Canada's home values have fallen back to where they were in February 2017 in real inflation-adjusted terms. If Australia's two most similar housing markets can experience severe corrections, why couldn't Australia? The analysis suggests it's an incredibly risky time to be leveraging into Australian property with a tiny deposit. The only caveat is Melbourne, which has experienced minimal price growth since the pandemic and where affordability has markedly improved, making it far less risky than other major capital city markets. Let's bring this all together. New Zealand's housing market is going through a significant correction, 17% down from the peak nationally, with Auckland and Wellington seeing even steeper declines. Traditional economic tools like interest rate cuts aren't providing the boost that theory would predict, largely because consumer psychology and confidence have fundamentally shifted. The market isn't frozen. There's still strong activity from first-home buyers and investors. Spring may bring increased competition as stock levels fall and sales volumes rise, but we're not expecting a boom anytime soon. But here's the genuinely good news. Housing affordability has improved to its best level in a decade. For first-home buyers, this represents a real opportunity to enter the market at price points and mortgage serviceability levels that simply haven't been available for years. If you're a young Kiwi who's been priced out for years, this correction, painful as it might be for existing owners, is creating opportunities that didn't exist at the peak. And if you're in Australia watching this unfold, there are serious lessons here about what happens when house prices become detached from fundamentals. If you found this analysis valuable, please hit that like button and subscribe to Kiwi Property Reports for more in-depth coverage of New Zealand property market. We'll be tracking this story closely as we move through the rest of 2025 and into 2026. Drop your thoughts in the comments below of what do you think about New Zealand's housing correction? Are you seeing opportunities emerge, or are you still waiting on the sidelines? Thanks for watching and see you in the next report.